Good morning, and thanks so much for tuning into the Trade Setup. I'm Neeraj Shah, and it's you could argue that in some fashion, what happened yesterday, the FOMC turned out to be on expected lines, and we'll talk about that in detail with our guest today. But just a quick synopsis of what happened to the markets thereby. Post the Fed and Janet Yellen's comments, the US markets gave up some bit of gains that they had and ended about 1.5% lower. And the news flow, is that FOMC's hiked rates by 25 basis points to a target range of 4.75 to 5%. In other news, by the way, not to miss out, China and Russia have deepened the nuclear concord that has Pentagon on the edge, most certainly. UK inflation has stayed high, and the BO is expected to hike rates by 25 basis points today, as per most consensus estimates. Now, what does all of this mean for risk assets worldwide? Let's get in somebody that we love talking to every time a big Fed event happens. Jeff Dennis needs no introduction now. For everybody who has joined us, he's now a fairly regular and well-known name. Jeff, good evening to you. Thank you for joining in. What did you make of the commentary from Jerome Powell and, of course, the action as well, which I would say largely was on expected lines?
Yes, I think the whole thing is very odd, actually. I think for the Fed to be raising interest rates at all here when they are doing, and so is the government, as much as they can to provide liquidity to the system, either through hopefully extending the insurance on bank deposits or these reenaction of these, I should say, these acceleration of these swap arrangements. That's trying to really provide liquidity in an environment where market conditions have tightened quite dramatically as a result of the events since Signature Bank and Silicon Valley Bank went bust, basically, to then suddenly come back and raise interest rates. I think is kind of odd, really. And my view here is that it would have been much better had the Fed held rates steady today and said, look, we're still keeping an eye on inflation, and on the assumption the concerns in the banking system settle down fairly quickly. If we need to, we'll go back to raising interest rates again. So I think it's all a bit odd, and I'm not particularly surprised the market is taking it rather badly, because I don't think this is the time when the Fed should be tightening monetary conditions. And I guess that's the point I'm trying to make here.
Yeah, but Jeff, here's therefore the question. As much as people think what should be the right thing to do, what I thought came out from the commentary was that more rate hikes are needed until inflation certainly cools off, because inflation seems to be too high. Now, my question is, does this sound like a Fed which is steadfastly looking at the inflation print as the North Star, and everything else does not mean as much? If the SVB crisis did not make the Fed budge, what else can?
No, I think that's right. It is telling you, and in fact, I believe they're right. Inflation should be the sort of guiding light of policy right now. But I would argue, and I've done this before on your show, that if inflation is falling, it's down to 6% now. It's going to continue to fall. It could be as low as 3.5% by the end of the year, with visibility about getting to 2% at some point in 2024. Wage inflation is under control, and even the more bearish of the commentators recently have been thinking that the Fed is only maybe 2, maybe 3 rate hikes away from the peak. So what would be the harm in pausing now to make sure that the banking system has got all the support it needs? In other words, what I'm really saying here is I think the Fed's action here today, by not particularly doing anything new to support the banking system, at the same time we need to raise rates, has actually materially increased the risk of recession in the US economy over the next, let's say, 3 to 9 months, because I don't think they should be raising rates any further when the banking system is still in distress.
Yeah, okay. So having said that, since they are doing that, Jeff, I would love to understand from you, what do you think is the impact on risk assets worldwide? There was a Nomura note this morning which spoke about how they are circumspect Asian stocks as well, despite the fact that they might selectively be optimistic, simply because they believe that a US recession and a market slowdown in the US is around the corner. And if that were to happen, very difficult to see other risk assets meaningfully outperform. So, led by the US, stay underweight risk assets for the time being, except for select bottom up ideas. What would your thoughts be?
Yeah, I think I mean, as you know, I've been very constructive and still am in principle constructive about emerging market equities this year. But I do think that for us is slightly put that under risk, at least in the very short term. Now, if you look at the market reactions today, which is equities down, bonds up, but the dollar down as well, that is not just a traditional flight to quality into bonds, because that would ordinarily give you a good bid on the dollar. And the fact that dollar's down at the same time as equities down and bonds are rallying is telling you, I think, the markets are more concerned about US recession than they were, as I say, a few days ago. Now, obviously, as you've heard from me many times, the lower dollar will ultimately be very, very beneficial for EM. So I think we need to get through this phase and get some sort of reassurance that the US economy is not going into recession, in which case the US market might be under more pressure because earnings may be too high. And we do need to know that, where is this peak of interest rates? Because I'm pretty sure the peak of inflation is behind us. And if the peak of inflation is behind us, the peak in rates should be very close now. And in that event, I think the dollar weakens possibly substantially, and then eventually some money does come into the emerging market universe, the risky asset universe. But right now, I think the Fed is unnecessarily muddied the waters here now. It's if I can use this expression, it's a sort of clunky response today. Oh my goodness, we got to tell the markets we're still serious about inflation. They know they're still serious about inflation. I think what they should be dealing with and making sure is stable is the financial system. And therefore, I think it puts the optimism potentially for risk assets on the back burner again for a period of time.
Thank you for giving us that lowdown, Jeff Dennis. Really appreciate your time this evening, and let's see if there are pivots along the way in due course. But much appreciate you giving us these insights today.
Thank you.
Well, that's the view from Jeff Dennis, and I think, let me just adjust this. All right, yeah, I think if he's echoing the voices that I've heard some of the other global money managers are also talking about. Chetan Seth of Nomura has put out that note today as well, that risk assets on the back burner. Don't quite think that's what you need to bet on currently. Maybe stay underweight equities, even Asia, except for select themes. So SGX Nifty reflecting that, maybe a little, 0.2% lower, and nothing too dramatic, but slightly lower. Now, what's the trade setup? Well, I do believe markets are likely to toe the global markets lower, and our performance is unlikely. Interestingly, though, pharma stocks are now starting to see some bottom formation. That's the one index that is trading below long-term averages. But in the last 5 or 6 days, I've seen Nifty Pharma being the best performing index, and that doesn't happen unless there's buying. Yesterday was a case in point, one and a few percentage points higher, while the rest of the indices were not quite there. And infra stocks getting orders at a furious pace. And I think that becomes a space to watch as well. I wouldn't normally say this, and I know this is a year end, and therefore all of these things would happen, but just the pace of ordering that is coming for most infra names at a point of time when the order books have come off, but not dramatically lower, is pretty interesting. Now, within all of this, really, with the dollar having done what it has done, the bonds having done what they've done, what are the specific stocks to watch out for today, in light of the fact that most people are now saying that they are not necessarily constructive equities too much? And we'll, by the way, talk to Mark Mobius about this at 9:30 a.m. My colleague Murli will be having a conversation with Mark Mobius later today. So that will be interesting. And I think at 10 or 10:30, either of the two times, we will talk to Ankur Rudra of JP Morgan on specific pockets like information technology. But frankly, if you want to know about risk assets at a global view, I think that is the conversation at 9:30 that you need to tune in. Now, what about specific stocks, as I was saying, to watch out for today? HAL, the government is going to sell up to 3.5% stake in HAL and OFS route at a price of about 2450 per share. So that is to be watched out for. Very likely there could be a start which is marginally soft. GR Infra projects. It's L1 for six laning of Surat, Nashik, Ahmednagar, Solapur greenfield stretch in Maharashtra for 872 crores, which is not bad. But also, it's been selected for construction of civil works at the Dibang multipurpose project in AP for about 3,600 crores. That's large numbers and certainly helps GR Infra projects as a stock. Remember, I've been talking about how some of these names, GR Infra, G Infra, PNC Infra, all of them have been getting orders. It's quite stunning, really, what's happening. Actually, can we do Edge Infra first, then we'll move on to Hero and Reliance Industries. But if we can, yeah, Edge Infra. The news first, of course, it's L1 for the Jharkhand West Bengal border project for about 764 crores. And then I just thought to add the perspective, Go India Stocks has this interesting narrative on Edge Infra. It's progressing at an impressive pace towards its guided order inflow of 9,000 crore plus for FY23, according to the firm. The company is well on track to diversifying its order book and business segments. And interestingly, it's not just right now. The last 4 years, there has been a revenue CAGR of 27%, profit growth of 42%. That's pretty strong. And the company is also in an advanced stage of monetization of its HAM projects, which will further provide a cushion for liquidity requirements. So ticks a number of boxes. I don't have a handle on the valuations, frankly. I just saw this note this morning. I saw the order win. I thought I should just bring it to notice that this is one more company that is consistently winning orders. And they've apparently done some good work in the last few days. Please do your own research before you go out and try and think about this. But it seemed impressive, so I just thought I should bring it to your notice. Then, some large caps in news. Hero MotoCorp will revise prices of select vehicles. I think most of these companies are doing this in order to meet the new emission norms starting April 1st. So just probably covers the cost, if you will. So do watch out for these. But do watch out for these nevertheless. At least they have the ability to be able to hike prices, especially in the case of Tata Motors and some of the others. So that's interesting. Then Reliance Industries plus FMCG names. I don't know which ones out here specifically, but most names which have a large presence in personal care and home care products. Reliance is making an entry. Usually it used to happen in the past, viewers, that whenever Reliance made an entry into a particular category, it used to impact the spaces or the companies in that pocket. Now, remember, FMCG firms are well entrenched. They've been around for a while. The distribution chains are so well set. The brands are so well known. I doubt there is immediate hiccups there. But the thing is, that you now have a deep-pocketed entrant into this space, which wants to make a mark, which has got its own retail presence, and that might make a difference. And part two, when I saw, I was reading this note from DSP Mutual Fund called the transcript. And when you look at the comments from most consumer companies, regional unbranded consumer firms or regional unbranded firms have made a big comeback across categories, be it plywoods and laminates, be it FMCG products, any consumption name. Unbranded local competition has seriously gone up. So not only are they hurting at the lower end, but with the organized platforms making their presence felt in the categories that they are present in, there's a bit of a hit at both ends for FMCG names. So be mindful of that. Sugar stocks might be in focus. White sugar has hit a 6-year high on mounting supply concerns as per Bloomberg. So that is to be watched out for. And last but not the least, I just thought I should bring the view on GAIL. Now, I'm bringing the MK view. There is Jeffries, which is constructive. I think Morgan probably is constructive. I'm not completely sure, but Jeffries is. But MK has downgraded GAIL from a buy to a hold at target price of 115. Remember, yesterday the tariff order came. It is here, and the outlook is favorable. But MK says the positives are priced in. Hike is about 33% for the integrated network by GAIL's own admission. The hike would amount to nearly 2,000 crores of annual EBITDA gain. They have revised their FY24 EPS by 5% as a result of this, but the FY25 earnings remain unchanged. And they say that there could be some upside risks as well if indeed another 10% tariff hike can come in, because GAIL is going to contest this order as well. Having said that, the stock price reaction, the gains that have happened in the past might be baking in some of the positives. So be mindful of that. In the same breath, though, I would want to say that there are some others which are constructive on this as well. So, for example, like I said, the Jeffries note on Gale, they say that the United tariff is positive, but the higher costs drag. However, they have a hold again, and they've raised the target price to 110, which is lower than MK's, by the way, and they are maintaining a hold on limited upside potential. So I think most people are actually saying this. I stand corrected. Most people are actually saying this, that it's a positive, but the upsides are already baked in. So be mindful of that. So that's the long and short of the trade setup today. Thanks so much for tuning in. No surprise from the Fed. If anything, the messaging is don't listen to the markets, listen to me. And clearly risk assets on the back burner for the time being. Thanks so much for actually, if you heard Manish Dangi day before yesterday on our show, frankly, he said the same thing and he predicted it well in advance while the market was all gung ho about a pause. Manish Dangi mentioned that quite categorically about what he thought. Pretty interesting conversation in case you want to go back and listen to what he has to say. Thanks so much for tuning in to the Trade Setup. Have a great day ahead. Do tune in for some of the conversations later in the day.